It cost individuals hundreds of millions, probably billions, maybe even tens of billions, and these motherfuckers should go to jail.
Just a few weeks ago, everyone from Joe Rogan to James Corden to your Nana were closely following the story of GameStop. Even AOC and soon-to-be Cancun Cruz were on the same page. Getting angry was trendy, and sharing a hashtag delete Robinhood was so much fun. Until eventually, as it always happens, the dust settled, and the eyeballs of the public are all somewhere else. But now that Mr. Deep Effing Value is facing a lawsuit while the big money is playing dumb, is now the time to let go and let them have their scapegoat. So, to remind you what is at stake, I would like to share with you this clip of a famous billionaire investor, Chamath Palihapitiya, who has been one of the loudest voices in the story, explaining what has actually happened.
In June of 2019, a Wall Street Bets user named Deep Value began buying long-dated January 21 calls. What that means is, in June of 19, this person was betting that the stock would go up by January of 2021. He spent $50,000, which, by the way, today is worth about $25 million.
By the way, Chamath, we should just highlight that there are forums where individuals that are trading stocks talk to each other and share tips and promote things to one another. That's where this was taking place.
Yeah, and by the way, those forums exist in the professional organized world too,
right,
amongst hedge funds. You know, I've been invited to idea dinners where we all get together and we talk about the ideas that we have, and we're all expected to do fundamental analysis. But some of those ideas are actually momentum-driven ideas. And a lot of the biggest dislocations in the market, just as a setup here, have been because of momentum-driven trading by organized capital. Okay, so we've been stuck with this for a while. So this guy, Deep Value, posts this, and every month since, he's posted a screenshot of his position, and he's titled it GME YOLO Update. August 22nd of 2019, Michael Burry, who is this guy famous from The Big Short, who's the guy that caught the mortgage thing, he discloses a 3% position in the company, and he highlights that 90% of GameStop's 5,700 stores are free cash flow positive. That's like pretty good. He urges a buyback, and he notes that the company was trading at or near net cash levels. So he's making a deep value oriented fundamental thesis as well. June 19 was the original post. August 22nd of 19, Michael Burry comes in and says, I'm long. Then a year later, August 31st of 2020, Ryan Cohen, who's the founder of Chewy, takes an almost 10% position in GameStop. About 2 or 3 weeks later, on September 19th of last year, a member of Wall Street Bets writes a post on GameStop, and he notes that GameStop has 120% short interest, which I'll get to in a second, so hold on. What does that mean, 120% short interest? And he defends the company as a result of a few things. He says, number one, there's a new console cycle coming, just as Jason mentioned. Number two, consoles are not going all digital immediately. GameStop loyalty programs have 55 million users. They have a strong balance sheet. Ryan Cohen just bought a stake. And the shorts were underwater and would be forced to cover if the stock ran up. He predicted the convergence of all these factors would lead to a big squeeze. Now, November 16th of 2020, Ryan Cohen writes a letter to the GameStop board, and he urges the company to conduct a strategic review and share a credible plan to capture market share in the gaming industry. He said that they need to evolve into a technology company that delights gamers and delivers exceptional digital experiences. I'm just quoting here. Not remain a video game retailer that over-prioritizes its brick-and-mortar footprint and stumbles around the online ecosystem. November of 2020, someone in Wall Street Bets highlights that a hedge fund called Melvin Capital was going long GameStop puts. What does that mean? That they are synthetically shorting the stock by buying the right to sell it at a different price in the future, okay? And that they had been long that position for more than 4 years. So all the way going back to 2016. Fast forward to now 2021 of this year. January of 2021, GameStop strikes an agreement with Ryan Cohen and adds him to the board of directors and gives 2 of his affiliates, his former COO and CFO of Chewy, also 2 board seats. They collectively, bring their experience in e-commerce, online marketing, finance, and strat planning. The stock goes up 13% on that day and closes at about $20 a share. One day later, and then over the next day after that, so for January 12th and 13th of 2021, there's a ton of activity around GameStop in Wall Street Bets, and now in Discord, and in StockTwits, claiming that Ryan Cohen is going to be the savior. And then by January 14th, so 3 days later, the stock closes at $40. So now it's up 125%. So now comes the setup, the pros versus the Joes. From January 12th to today, there has basically been a battle by institutional investors on one side, shorting GameStop, and retail investors on the other, buying the stock and also buying the right to buy the stock, or what's called call options. And this is what has created this crazy nonsense we've seen. So on the institutional side, after, retail drives the stock up, the institutional guys are like, hey, wait a minute, Ryan Cohen's an idiot. This company is fucked. F these guys. They have too many, cyclical and secular tailwinds. And they become so massively short that the infrastructure that's supposed to even count all the shares can't keep up. And now they are short more than the actual number of shares that actually exist. So now they're 140% short. The Joes, retail, they start to aggressively purchase all these call options. And on January 13th and 14th, this price keeps ticking up. Then a bunch of quant funds and momentum hedge funds notice all this activity, and they also participate on the long side. And then over the past 7 trading days, we have traded over $100 billion of stock in GameStop, which is well in excess of what retail can support. So here's what's crazy to realize. A bunch of value-oriented, non-computerized, non-quantitative hedge funds short. Retail notices a dislocation, initially fundamentally, but then momentum-oriented buys. Other hedge funds realize, also buy, and this is what's created this massive short squeeze. On January 19th, Citron Research, a research firm that basically tries to, find shorts in the market, announces that they were short GameStop, and they gave 5 reasons why it should go to $20. The stock was at $35.50 on January 19th. Then over the next 2 days, GameStop calls hit an all-time high, and it runs a 2-day rally of almost 70%. And this is what really starts what's called a gamma squeeze, okay, which is what we saw in the first part of this week. So January 25th, Ken Griffin, Stevie Cohen, they inject almost $3 billion into Melvin Capital, the firm that was short, $2 billion from Citadel and $750 from Stevie Cohen. Stevie Cohen had $1 billion in it from before. And then now all of a sudden, the squeeze keeps happening. And then it starts to spill over to the rest of the market. Now, all these hedge funds, these original hedge funds, they are getting called by the bank saying, hey, wait a minute, you've run over your collateral limits. You need to post more collateral. We need more money in your bank accounts. So now not only do they have to cover GameStop, they have to cover all their other shorts. So those go crazy. And they have to sell their longs. So now they're selling Facebook, Netflix, Alibaba. And so those things are going down. That accordion is what's been happening in the market in the last couple of days. And then the coup de grace is what happened on January 28th of 2021. Brokerage firms, and this is where, Jason, we should talk about this, like Robinhood and Interactive Brokers, because in fairness, it wasn't just Robinhood, prevented their users from buying GameStop and a handful of other stocks. They were only able to sell, which resulted in such a one-way pressure, it caused a 44% sell-off yesterday. Now, that's been reversed today. And so what it speaks to is a bunch of questions. There are questions as to whether or not this was mandated by the platforms or the regulators. Given the fact that it didn't impact all the brokerage accounts, it was a platform-level decision. So some organizations like Robinhood banned it. Some organizations did not. And it could be that some of these platforms that banned it is likely because, and this is where we get to the insolvency question, didn't have enough margin. And so they knew that if they opened the doors, there would be a run on the bank and there would be a run on Robinhood. And that's why they basically, I believe, had to stop allowing people to trade. If we had to summarize all of this in a nutshell, that's what we know. We know that it started out as people debating the true fundamental value of GameStop, and it morphed into a momentum trade where a bunch of folks got dogmatic about a short, a bunch of folks got dogmatic about being long, and the longs won. And in the middle, what happened was a bunch of firms basically decided at some point to gate the ability for people to transact in all of this, which I think caused a lot of economic disruption. And that was because they didn't have the margin requirements. And I think it's because they were insolvent. When you buy a call, when you as a user, when David Friedberg, Quinoa buys a call, Robinhood becomes synthetically shorted, right? Robinhood doesn't have the share to sell you, but it's giving it to you. So they're technically short. They got to go buy it. Okay. So this is what creates this dynamic where Robinhood knew. They knew every second of every moment what was happening and, more importantly, what could happen. At a minimum, it's negligence, and at a maximum, it's the fix. You can't say some stocks on certain days, some stocks on other days, some options over here, some puts over there. That means you're a f***ing moron. If you were a reasonable manager of a business like this conversation would have been happening at a board meeting. It needs to happen quarters ago. And in quarters ago, what they would have said is, hey guys, we've run some scenario analyses. We've done some sensitivity analyses. Here's what happens if all of these things can go against us. That's a typical stress test that a bank has to do. You prevented people from transacting in an open market. And when people signed up to use the service, that's what they thought they were signing up for. And they thought that the risk on the back end would be managed. You have to remember, it's not that the individuals did anything wrong by buying or selling. It's that Robinhood did something wrong by not being able to manage their business accurately. And then that impacted the users to the tune of tens of billions of dollars. That has to get adjudicated. Tens of millions of people that had their hard-earned money inside of Robinhood was prevented from participating in trades that could have been executed other places because of an arbitrary decision by Robinhood that they had at a minimum.
It wasn't arbitrary. They had to stay insolvent. How is that
Jason,
an arbitrary decision? Do you think they wanted to make that decision?
Jason, that's me telling you that they were insolvent. That's not them saying it. This is what I'm saying. Right now,
the communication was not perfect. I'll agree.
Jason, it's beyond poor communication. People were blocked out of their accounts. Like there was hundreds of incalculable amounts of economic loss.
I don't know if that's going to wind up being true because all these trades are occurring now and the stock is a rocket ship. Who's to say that?
No. The effects of that decision they made to stop trading, and specifically, they didn't stop people from selling. They only stopped people from buying. So they shut down one side of the trade. And the effect of that was we had these hedge funds from Wall Street. They were on the ropes, right? I mean, let's discuss who these guys are. These are the apex predators of Wall Street. They are in the business of shorting companies to destroy them. I mean, that is their business model. And they are not academic traders, okay, who are just speculating on outcome. They engineer the outcome. The beautiful thing is you had these Reddit kids, these pirates, who published this manifesto, right, on Reddit, basically being the heirs to Occupy Wall Street. They recognize, look, occupying like a physical space does nothing to these guys. We are going to hurt them where it counts in their pocketbook. We are going to get together and we're going to basically create a trade mob that's even bigger than their cartel. And they did. They got 2.7 million people taking the other side of this trade. And then when the hedge funds doubled down, they said, F you, we're going to triple down. And the guy on Reddit said, listen, he, paraphrasing John Maynard Keynes, said, we can be retarded longer than you can be solvent. And they were winning. That was what they said, right? And they were winning the trade, okay? And Melvin was dead busted and Citron was on its way to being dead busted. And they had to go to Big Papa Stevie Cohn, okay? And Ken Griffin to get their rebuys, to buy their rebuys to get back into the game, okay? And then they had these guys on the ropes. They had them felted, okay? And then what happens? Just at the moment where they're going to basically bust them out of the game for good, Robinhood shuts down the buy side of the trade. And so what does that do? It gives these hedge funds time to regroup, to unspool the trade, to reposition, and save themselves, and to get out of the trade if they want to get out of the trade. You can never take that 24-hour time period back. no matter what Robinhood does now.
The multiple conflicts of interest exposed by this story is just mind-boggling. I believe we should all pay closer attention to how the story develops further and see if Lady Justice turns out to be just a whore. I also encourage you to go and watch or listen to the full heated debate in this episode of All In Podcast and see if you will be able to tell which one of the hosts has invested in Robinhood.